Thank you, everybody, for joining us today. Richard Hammel is our guest speaker. He works with Hammel Valuation Group. He is an appraiser, and we actually met through real estate. He has a whole heck of a lot of information to impart with us today. And if you don't mind, Richard, give us a little bit about your background and what you do, and the floor is yours.
Thank you. I appreciate that. So I've been doing appraising since I got out of college. And as you can tell, I've got some gray hair here. It's been quite some time that I've been doing it. And probably within about 4 years, I'm going to, probably retiring. So I've been doing it for quite some time. I've enjoyed it tremendously. It's a fun chance to go out and interact with people and also look at data and also get a chance to get familiarized with different property types and appraise all different kinds of properties all over the Southland. My practice primarily focuses on apartments, office, industrial, and retail. Those are the 4 major food groups that I'm involved in on a regular basis. And I did start appraising homes and condos and small income properties back in 1991. But roughly 1993, 1994, my boss said, you've got a college degree. Let's get you into doing some investment type property. So I started appraising apartments, and then little by little, I got into retail and office and industrial after that. I have worked at basically 2 companies. The first company I worked at was PCV Mercor, a very big appraisal firm. They're located in the eastern part of LA County, but they do business all over the country. And then secondarily after that, I went to work for Integra Realty Resources there in the Valley. John Ellis headed up that office, and I was there for about maybe 3 or 4 years. And then roughly in 2003, 2004, I struck out on my own, and I've been on my own ever since. I've had a small appraisal shop for some time now. And I stopped counting how many properties I appraised a while back, but it's been hundreds and hundreds. I think it's about 1,000 right now, and over $1 billion in total valuation. So been enjoying it quite a bit. Obviously, if I'm still doing it now, I definitely have been enjoying it. But just to kind of talk a little bit about what's happening with the market, I want to go through like the 4 major property types that I mentioned, and I'll just kind of provide a little bit of historical context, then go into some of the data to see what has happened, and then of course wrap it up by talking a little bit about the future and how good our crystal ball is. And I think right now everybody's trying to figure it out. I think it's more of like one of those magic 8 balls where you're shaking it trying to figure out what the future holds than it is an actual magic ball. But let's start a little bit just by talking just generally. I like to use the word pre-COVID because pre-COVID kind of tells us that the market was working, doing its thing without any undue outside influence. And it always has influences, but they're typically influences that we can kind of look at, we can kind of analyze, and try to weave those into what we're seeing in terms of the numbers. The COVID pandemic was something very unusual because I had not lived through a pandemic. I think most of us probably haven't. And there was no data back then to kind of see what the impacts were because of having a pandemic and what that meant. So it was kind of new area to all of us. And, there were some days when I would wake up and I'd watch the news and I thought, oh my gosh, we're all going to die and the markets are going to crash. And what's going to be the post-apocalyptic version of our lives? And then, of course, there were other days when you'd say, man, it looks like we're really solving this problem and we're making some good headway on it. And it definitely has been a bumpy ride. So let's talk a little bit about just kind of more the COVID kind of environment and what's been happening in recent months. And then at the end, I'll kind of talk a little bit more about what's happening right now. What has been an additional outside stimulus or influence that has really had an impact on the markets. And so what I'll do is I put together a brief overview, and I wanted to start with the retail market. Let's see if I can figure out how to share this with you. Oh, I lost everybody. Oh, there we go. Okay. So share screen. Yeah, here we go. And I apologize. I'm a little bit of a newbie at doing these Zoom meetings. I apologize. Okay. Can anybody see what I'm trying to share?
Yes, we can see it. Mhm.
Okay, perfect. Because I'm having. Okay. Somehow I have goofed things up a little bit. All right. Well, I can't see it on my side, but I can definitely see the file that I'm referring to. So I wanted to start off with the retail market. And the reason I wanted to start off with that is because retail was kind of like ground zero for the whole COVID experience. And it's not a good way to put that, but it kind of really was the primary segment of the market that I think everybody was focusing on so carefully. Why? Because in-person type businesses really were the first ones to get hit with all the closures, right? So many different restaurants and retail stores had to close down for a number of months before they could kind of get back on their feet. And I recall appraising a property about 1.5 years ago, and it was in, I believe, the Marina del Rey area at a major intersection. And that property was a small strip center, and it had 5 tenants, of which one was still paying the rent, because they were a national store, and they had a national presence, and the services that they provided were considered to be very important, essential services. So they were able to stay open, and they were paying the rent, but everybody else had pretty much closed up, including the largest tenant, which occupied 40% of the shopping center. They did primarily in-person type services, and they had to close down. So that was kind of an eye-opening experience for me, to walk into a shopping center where most of the tenants were not paying rent, not because they didn't want to, but simply because they just couldn't do business. And that, of course, happened in the very beginning of 2020. So if we take a look at what was happening back then, rent was about a little bit over $2.70 a foot, $2.70 per square foot. And vacancy was right around 5%, roughly. And what happened afterwards? Well, vacancy went up a little bit. Looks like it went up to about 5.5% up until the second quarter of 2021. And then things started to improve. Why so? Because at that point, people were beginning to realize, we've got vaccines either out or they're coming. And people were beginning to see that the market really did have a little bit of depth to it. And more importantly, businesses weren't being closed down, which was kind of the big thing for them. Because as soon as they had to close down mandatorily by mandate, then they couldn't do any business. So at that point, it was interesting because we began to see vacancy coming down, but at the same time, we saw asking rents going up, right? So at the beginning of 2021, or actually the middle, we start to see an increase in the asking rents for the vacant space. And at the same time, we're seeing a decline in vacancy. And it's important to note too that these numbers, especially in 2021, we began to see more concessions. So the numbers that you're looking at are asking rents, not effective rents after the concessions. But still, what we're seeing is an interesting increase in the rent per square foot, along with a gradual decrease in the vacancy rate. And so far, up to this point, the retail market has been doing fairly well. It's recovering. People seem to be a bit more confident in it as a product type. And overall, it did get hit. There was some pain, there was some difficulty as landlords kind of worked through several months of not collecting any rents. But now, any tenant that wasn't paying rent has pretty much left at this point. They've replaced them with a new tenant, and they're cash flowing once again, which is pretty good. One of the interesting markets that really, to me, was kind of very it was affected, but in a surprising way. It was very surprising to me, was the industrial market. And of course, if you're an active investor, you probably already know this. You don't need me to talk about it too much, but nobody really saw that coming. That was very unexpected. And let me show you some statistics with what happened with the industrial market over the last 2 years. This is going to be the best performing market, which received a boost from COVID. Who would have guessed? So if we look at this product type, we start off at about a 3% vacancy rate at the beginning of 2020. And as things got worse, vacancy actually went down. And it went down to maybe about 0.5% as of the fourth quarter of 2021. Now we're seeing it climb back up just a little bit. But what's fascinating to me is that this market has traditionally been a very stable market with very small increases in rental rates. And that kind of continued to play out for about the first 4 quarters. And then what happened? As vacancy went way down, rents went way up, more so than anybody could have expected. So if we take a look at 2021 third quarter, they were just a hair above $1.20, maybe about $1.27 or so, not even $1.30. And today, they've gotten up to about $1.70 per square foot. That's a huge increase. That is not what you would expect when you are in a recessionary environment. It's not what you would expect in any kind of situation where the economy is not doing that great. And yet here we have the statistics in front of us. Industrial really, really took off. Now, I am hearing from some of the industrial brokers that activity is kind of quieting down a little bit. And I'll talk a little bit more about some future impacts to the industrial market when I start wrapping things up. But really, the industrial market has been truly the best performing market in terms of the commercial real estate segment, bar none. So what was a sleepy, quiet, fairly safe investment vehicle that kind of gradually saw gradual increases in the last year, rents have completely popped. They've just exploded. And it makes sense. People weren't really shopping in stores as much. They were definitely doing a lot of internet type sales. People found that Amazon was a great place to sell stuff. And so was eBay, interestingly enough. And in Orange County, you have little small, what we would call a flex industrial kind of product, just full of people that are reselling stuff for Amazon on Amazon. Amazon sells more stuff from other people than it sells of its own, which is interesting. Most of the people that are selling today or most of the products that are sold on Amazon today come from small people that are working out of a little tiny warehouse space, and they tend to be located in Southern California. They're all over the country, but there's quite a few of them here in Southern California, and kind of makes sense, you know. And there'll be some interplay too going on between this product type and the retail a little bit later, but we'll touch on that when we get to that point. So, you know, here we have retail, going back to the retail market. Yeah, it had some difficulty, it had some pain, and then we get to the industrial market, and COVID was something that really stimulated that market tremendously. Unexpected. Nobody really saw it coming until it started happening, and then everybody said, hey, that kind of makes sense. But there was no historical basis for understanding what would happen with that segment of the market. So let's move on to the third segment, and that is the apartment market. And that for me was a big question. What are people going to do? Are they going to relocate to less dense areas? Are they going to, you know, head off to Ohio or Kansas or something like that to get away from this pandemic? Because we had a tremendous number of people who started working from home. And we've all heard the stories. We probably even have family members. We probably have friends who talk about, oh, you know, this person who used to live next to me, they moved, Kansas. They moved to Kansas because it's cheaper. They can work from home and everything's fine. And so there was some speculation about that. But here we have the data right in front of us. We can take a look at it. So at the beginning of 2020, within LA County, the apartment vacancy rate was about 5.5%, roughly. And as the pandemic continued, the vacancy rate stayed pretty high until we get to the first quarter of 2021. And then it drops precipitously. We're heading down towards the 3% range. And that's been the case probably for about 5 quarters now. We have very low vacancy. Interestingly enough, asking rents did go down at the very beginning, during the very beginning of the pandemic. And you can see that here in the lower left-hand side of the chart. But then as vacancy started to go down, landlords said, wait a minute, you know, we haven't really raised the rents that much in a while. We need to start asking a little bit more. And you can see this trend right here. Now, I would point out that as we get closer to today, the increase in the asking rent is kind of flattening out a little bit. And vacancy headed down in the same quarter during the same time period. So it's interesting to see it'll be interesting to see what happens in the future with the asking rents. But vacancy, it looks like it's going to stay rather low until we have some kind of a major event. The apartment market has been very strong for a number of years, and anybody who invests in commercial real estate in Southern California often has at least 1 or 2 apartment buildings, whether they've purchased them outright or they've done it as part of a partnership. Quite a few people are familiar with the apartment market, and it's just been very steady, very stable. Cap rates have been relatively low, close to 4%. Sometimes as high as 5%, depending on the market and the age of the property and the product type that's being offered. But for the most part, it's been a fairly stable, fairly safe place to invest. Yields may not be fantastic, but they're pretty steady, and people feel very comfortable purchasing them. So we've covered 3 of the food groups. What about the 4th one? Office properties. And office properties at the beginning of the pandemic, nobody was really thinking about them because office properties have businesses in there that don't do in-person type stuff. So they really didn't, they had to kind of close down, but you're not dependent on being able to sell a service or product or food to somebody coming in off the street. You're still doing business with the people. Who are we talking about? Accountants, insurance brokers, people that do a lot of more paperwork type stuff versus selling things. And at the very beginning, there was some discussion about it, but nobody was really focusing too much on the office market. Let's take a look at it. Now, I would like to point out that on the left-hand side of the screen, right here, I've really had to change dramatically the scaling. And the reason for that is because from a historical standpoint, the office market received a lot of product back in the 1980s, roughly, really built a tremendous amount of office product. And we had, for example, a lot of savings and loans at that time were investing very heavily in developing apartment buildings, as well as a lot of office buildings. And we had kind of an overbuilding boom. And that supply really carried us through for quite a long time in LA County, carried us through the 90s and the 2000s, with more product being built in recent years. But for the most part, the market had a lot of vacancy. And what's a lot? Well, it depends on who you talk to, but generally speaking, most people in real estate, most economists think that somewhere between 3 and 5% is the ideal amount of vacancy to have. Why? Well, because that means that if somebody gets out of one size and they want to get a little bit bigger, they can find another property that's a little bit bigger. The same thing with somebody who might want to downsize. But there's constantly people moving back and forth within the office market in really any market. But 5% vacancy has been kind of suggested as being a good rate of vacancy that would allow people to move around without too much difficulty. Here we have a market that at the very beginning of the COVID pandemic was slightly below 11% in terms of vacancy. And what has happened is vacancy has increased, and it continues to increase today. It's up to over 13%. We're up at 14% roughly as of the third quarter of 2022. Now, here's something very interesting. If you take a look at the asking rents were right around probably 320 or so. They went down a little bit at the beginning of the pandemic, but then what happened? Landlords started asking more rent and more rent and more rent at the same time that vacancy had gone up. It's an interesting anomaly, but now we're finally seeing landlords starting to reduce their asking rents, and they've been doing so for, it looks like, about 3 quarters now. Not too much, but just a little bit. And the office market back in the 80s, as I mentioned, got kind of overbuilt. It carried over into the 90s and the 2000s. But in recent years, particularly in West LA with the advent of Silicon Beach, we saw a lot more interest in office product. It became very popular. And that additional demand coming from the people who are in kind of the computer side and the entertainment side both meshed together in Silicon Beach, and they tried to find ways to make, put movies on the internet and come up with social media and find ways to bring in video clips and things like that into social media. It became quite the popular thing. So the office market became quite popular up until COVID. And then COVID struck. And we're not seeing that firmness return after we've kind of, I don't want to say that we're out of COVID. We're not necessarily post-COVID, but I would say that the whole environment is radically different from when it was at the beginning of 2020. People are starting to go back to work. And the big question moving forward is, will they continue going back to work? There is a firm that tracks office usage, and it's a firm that provides security services for office buildings. And what they do is they track whenever an employee goes in and they swipe their card or they put their fob against a little thing, they track, not with specific data, but with anonymous data. They're able to track how many people are going back into the office. And the last statistic that I read, I think it came out maybe about 2 or 3 weeks ago or so, was that 40% of the people that were previously going to the office were once again coming back to the office. So there was a higher utilization rate, but pre-COVID, it was about 80 to 85%. So we still have a long ways to go. So there's a question in everybody's minds, will this be a structural change? Will people return to the office? And right now, we're kind of seeing it play out in the media, where the CEOs say, like, the head of JP Morgan Chase, he really wants everybody to come back in. He really thinks that's important. And he wants everybody to be back in-house. That's his desire. But they've gotten pushback from employees. And so they've kind of backed away from that a little bit. I believe her name is Marissa Mayer, who was at Yahoo, had said, work from home doesn't work. And yet other tech CEOs have come forward and said, we're doing pretty good. In fact, people really like working from home and they're happier, and we should let them work from home. So I don't think that the CEOs have a definitive answer on where they want to go. Across the board, we all know where the employees want to go. They want to just stay home. But a lot of people that have any kind of team environment, they seem to be really hoping for a return to the office. I've done appraisals in Burbank with some of the media companies, and they're really finding that there is a synergy when you have the whole team inside the office. So some segments of the office market really do want to return to in-person type work. Other segments of the market, I don't think there's a firm consensus on that yet. And so it'll be interesting to see what happens with office product as we move forward. And so that's kind of a general overview of the 4 major investment groups in Southern California. And so here are some of the question marks moving forward, right? And of course, the big 800-pound gorilla, interest rates. Oh my gosh, what's the impact of interest rates on the market? And I think everybody's kind of scratching their heads trying to figure out, how do we make this deal work with a rate that is, 300 basis points higher than what they thought they would have. It's been a very tough market right now for buyers and sellers both. I've heard people talk about interest rate buy downs as a way to be able to pull in clients. People are trying to speculate on what's going to happen with the interest rates. And I was doing a brief tour of the South just about 3 weeks ago or so. And I took some time aside to kind of watch what the Fed was going to be doing. And I realized that we were going to be in for a period of high interest rates for a while. It's so hard to say, but that was the first time I heard of someone talking about the importance of tamping down the inflation rate, but tamping it down good, meaning that they're going to keep the rates high until inflation goes down, and then they're going to wait another 2 quarters to just see if everything stays with low inflation. And it kind of makes sense. I mean, if you think about it, from the federal government's perspective, they're paying a lot of people a lot of money every single month, whether it's Social Security, Medicare, federal employees, that's a huge payroll. And a lot of these labor contracts are tied to the cost of consumer goods, CPI index, something along those lines. And now they're going to have to spend 8% more when they were thinking 2.5% more. What does that do to the budget? It really has a big impact on the federal budget, certainly. And so it's understandable that they want to bring the interest rates down they want to bring inflation down. But the only tool that they've got that they think is in their arsenal is raising interest rates. And so right now, everybody's trying to figure out what that means. Well, that in some cases, when it comes to properties like a single family, it's particularly so because everybody's really oftentimes doing a 70% LTV. Unless they're an FHA buyer, then they're doing a 95, 97% LTV. Such a big criteria. How about investors? Lately, investors haven't been really going with higher loan to value ratio loans. Typically, we're seeing right around 50, 60%, something like that. So it's not as big of a part of the picture, but it's a big question mark. What are some of the things that I'm hearing from brokers? Well, maybe we can raise rents enough to offset this increase in the interest rate. Maybe so. And maybe that's what we're seeing in some of the charts, where people are trying to start building up that rental rate, so that they can afford the new interest rates that are coming their way. Something else that's a consideration is people may start just doing all cash deals instead of doing financing. Why? Well, instead of buying a 50-unit apartment building and putting down 50%, maybe they'll buy a 25-unit apartment building and buy it all cash. That's a possibility. Not always the case. Some people always have a favorite product type and they have a favorite niche, so they always want to be in that niche. That might hold them back a little bit. But having said that, that's the big question mark. Absolutely the biggest question mark right now for the market and where things are going to land. I think at the very beginning, people were talking about, oh, it's just going to be a temporary increase, and then we're going to go back down to the 3% interest rates. The more that these rates are higher, the harder it is to predict if and when we'll start seeing an easing of monetary policy, and that's having just making a lot of people pause right now. I think that would be a good way to put it. So what are some of the interplays that we've been seeing between these different product types? What's going to happen? For example, retail, at the very beginning of COVID, probably about 6 months in or so, you started to see articles saying, well, boy, we're going to have to take all of our retail and turn it into something different. Right? We're going to turn it into apartments. We're going to turn it into office. We're going to turn it into, long-term care facilities. And this is happening on the national level with some of the major shopping malls that have gotten kind of dated. And they are seeking a new product to bring in. Interestingly enough, Amazon has been leasing some anchor space and turning the anchor space in some shopping malls into distribution centers. So we're seeing a very unusual shift where in some very few cases, but some cases, you're taking a retail property and turning it into basically what is an industrial property. For the longest time, retail was considered to be, gosh, that's just the most awesome thing to invest in. And it's got great rental rates and it's got great sale prices. And industrials moving into retail, what is going on with that? And it's because there's been so much demand from people who are trying to bring in product at the last minute, the last mile delivery. There's just been a tremendous amount of competition for industrial product. Office moving forward, a lot of question marks there, like what's going to happen. And Candace and I were talking a little bit about a building in Glendale that used to have office and has since been converted into a mixed-use building with retail on the ground floor, and second floor and above, everything has become apartments. It was in Glendale, and there's very high demand for high-priced apartments in Glendale. So maybe that's part of it. But the reality is the office market's got a lot of questions. And it's funny because at the very beginning of the pandemic, nobody was paying attention to it. 3 quarters in, everybody was thinking, okay, it's going to have some kind of an impact. And today, just a lot of question marks surrounding that particular product type. Apartments still seem to be doing very well, and people are trying to move forward with some new development if they can. The same thing holds true with industrial. All the pace of development activity seems to be slowing a little bit. One interesting comment I would make about the industrial is that I read an article recently that Amazon considers itself to be oversupplied with industrial space. In fact, it believes that it has an oversupply of about 9%. And they've been thinking very hard about turning around and subleasing that space to other firms. Hasn't happened yet that I'm aware of, but there has been some discussion within the upper levels at Amazon over this issue. And if Amazon thinks it has too much space, maybe there are some other companies that might be thinking the same thing. So industrial is clearly the segment that came out ahead because of COVID. Moving forward, not quite sure what's going to happen, but it still seems to be quite solid overall. And office, on the other hand, seems to have some challenges ahead for it. So why was I in the South? Well, I'll share with you what I was doing in the South. I really hadn't been there in a very long time. I think I drove through there a while back with my mom and dad, and I want to go back about 30 years now. But since then, I hadn't been there. And what happened was I was looking at some of the rates of return that I was seeing in a variety of different properties that I was looking at. And I looked at the cap rate. I said, boy, this property's got a 4.2 cap rate, but if I go out and I get a loan on it, it's going to be a 5.7% interest rate. Ah, geez, that means I'm going to be negatively leveraged. I'm going to reach into my pocket and spend more money out of my pocket to, make sure I cover the mortgage. Where could I go to invest some money that would have maybe a little bit more favorable returns? So I started by going up the West Coast. I just went up the West Coast. I looked at Oregon. I looked at the state of Washington, and both states have their own pros and cons. but the rates of return were quite similar to those in California. So I did just a little bit of research. I started looking at places that had low taxes, business friendly. They were known for being friendly to real estate developers, meaning you were going to see some more development in the future. Whereas, in Southern California, they just recently passed a law that you can't really build anything over, I think it's 100,000 square feet without jumping through a bunch of extra hoops now. It's like, boy, now they're focusing, their focus has shifted from apartments and moved over to the industrial market. So after doing all this research and just looking at different surveys and kind of considering different locations, I thought, I need to go take a look at the South. And the reason I said that is because the cap rates that I was seeing for product in the South were significantly higher than they were in Southern California. Having said that, I'm not saying that the South is the perfect place to be for everybody, but it definitely has a lot of appeal in terms of how much bang for your buck you can get. And I'll give you an example. I appraised a property recently in the city of Long Beach, and I'll just talk about one of the comparables that I used for that analysis. The property had very small units, smaller than 400 square feet. They were all about 380, 390 square feet roughly. And they were all one bedrooms, very small one bedrooms, no on-site parking, no laundry room. And it sold for, I think it was about $210,000 per unit. Okay, that's not a bad price per unit. I mean, if you invest in Southern California, you're used to seeing 300,000, and in West LA, 500,000, 600,000 per unit. The rate of return for that property was about 4.2%. It didn't seem to be affected by anything in particular. It seemed to be a fairly common cap rate for the apartment market for anything that had a little bit of upside potential. So we're talking about a building that was built in 1923. It's 99 years old. It's very small, no parking. It's worth $210,000 a door and a 4.2 cap rate. I flew to Memphis, Tennessee, and I drove through all of Tennessee. I went to Nashville, Knoxville. I went over the border, went into Raleigh, Durham, North Carolina, Asheville, North Carolina, Asheville with an A, Greenville, South Carolina, Evans, Georgia, Macon, Georgia. Gosh, where else did I go? Savannah, Georgia, Jacksonville, Florida. Just trying to see what was happening with those markets. And it was very, very interesting. And I'll just share with you that the first place that I really started looking at sales was just north of Nashville in a small town called Clarksville. It's about maybe 20 minutes north of Nashville. And I came across two sales that really just made my jaw drop. The first one was a property that was built last year, C of O's were issued, I think, in 2021. The property sold just recently, and the property sold, they're brand new units, 1,100 square feet each, 2 bedrooms, 2.5 baths. It just looked like almost like a Southern California condo complex with, walk-up units in it. Just like, I think about 100 of them altogether. And that complex sold for $165,000 per door. Brand new. More than double the size. Brand new, $165,000 per door. And the cap rate on that deal, I believe, was about a 6.2, roughly. And then we went and looked at another sale that was close by. That was also newer. I think it was about 5 or 8 years old, roughly. Also 2-bedroom units, $135,000 per unit. And I think that was a 6.3 cap rate, either 6.1 or 6.3 cap rate versus the 4.2 that you would get for a 100-year-old building in Los Angeles. Now, does that really reflect everything? Not necessarily. Why? Because Southern California does benefit from appreciation, and anybody who's invested in Southern California the last 10 years definitely has seen a tremendous amount of appreciation. You probably don't get that kind of appreciation in the South. Not categorically, but looking at some historical sales that I came across, doesn't look like the appreciation rate is there, but the cash flow rate, if you're looking for cash flow, that's a pretty good return. Why? Because you can still get, well, as of when I was doing my research, you could get a loan for like, 5 point something percent, 5.2, 5.3%. You'd be positively leveraged by investing in the South, as opposed to being negatively leveraged if you invested in Los Angeles County. Will this change? Hopefully so. We're all crossing our fingers to see the interest rates go back down again, which would be a positive thing. But I thought that was very telling. And when I was there, I didn't see what I thought I would see. I just saw regular people with regular jobs, working, enjoying themselves, and not a lot of my preconceptions of being in the South at all. In fact, I was looking for them and I couldn't find them. And very interesting how their economies have kind of evolved quite a bit. One interesting and small little informal tidbit that I'll share with you. One of the questions that I've been asking here in Southern California has been, I go into properties that I appraise or properties that I'm using as comps, comparables, comparable rents, comparable sales. And I'll ask people in those shopping centers, like, hey, how are things going for you compared to pre-COVID? Have you bounced back? Are you exceeding COVID? Are you below COVID? Where are you at roughly? And on the retail side, quite a few people are still trying to get back to the pre-COVID level, right? They're still trying to work their way back to that profitability. And South Carolina, Georgia, and Florida, I got kind of the same response. I was very surprised to hear that Florida is still trying to bounce back. Forget about the hurricane. Now it's, the hurricane's really messed everything up. But this was right before the hurricane hit. But Tennessee, everybody I talked to in Tennessee said that they were doing better than before the pandemic. And this was in both Knoxville and Nashville. And very informal survey. I'm going to just put that out there. I'm not a professional survey taker, but I found it fascinating that everybody I talked to in Tennessee seemed to be telling me they're doing phenomenally well in that state. They seem to be on fire. They're drawing a lot of manufacturing companies and doing quite well there. So I did end up in Florida. And the reason I ended up in Florida is that I'm kind of looking for a place to retire. And I happen to like to do stuff on the water. And the water in Florida is nice, and there's lots of it. And there's a lot of great, fantastic islands that you can go visit. Very close to Florida. What do I mean? Bahamas, collection of 700 islands right off the coast of Florida, 80 miles off the coast of Florida, and you're in a totally different country. Yes, they speak English there, but it's a very fun place to be. And then you have all of the Caribbean islands as you go farther down, very close by. In contrast, Southern California, we have some beautiful islands off our coast. I'm talking about the Channel Islands, the 11 islands off the coast of California. Gorgeous, a lot of fun to be there. Nothing like sailing over to Catalina and enjoying Catalina for a few days. But if you want to go to any other islands besides that, you got to set your ship due west and go about 2,400 miles. And then you come to Hawaii. That's your next set of islands that you can enjoy. That's a long trip by boat. Oh my gosh. Bahamas, a little bit better in that regard. So I'm in Florida. I'm looking for a retirement place. My brother lives in St. Augustine, Florida. That's the northeastern part, the Atlantic side of Florida. And I did some research and I said, boy, I really don't want to be bothered by a hurricane. Let me go look online and find out what's a good place to be in Florida to avoid the hurricanes. And I found a US government map that talked about high-risk areas versus low-risk areas. So I decided I'm going to go to the low-risk areas. And that's how I ended up in Fort Myers, Florida, before the hurricane. Yes, Fort Myers, Florida, before the hurricane, because the risk of hurricanes in that part of Florida was very, very low. the point that I'm trying to make is that, we all look at numbers and statistics all the time. We look at data as much as we can, try to find out the best place, whatever it is that we're looking for, you're trying to find some good data. I found some good data. It was accurate up until about 10 days ago. And then things changed dramatically. So I'll just leave it at that. Just some thoughts on, we all try to figure out what's happening with the market or where the market's going. And we look at the best statistics we can find. And sometimes something comes along and just, boy, oh boy, just really teaches us a lesson. So that pretty much wraps up my presentation. And I'll hand it back over to Candace. You had mentioned a Q&A kind of a session. So whatever you want to do is fine with me.
Richard, we cannot thank you enough for that epic analysis, not only of like Southern California, Greater LA, commercial, industrial, retail, real estate, but also of your little road trip in search of a place to retire. I mean, I think ultimately a lot of us do think about the next step in our life, whether it's for us ourselves or our clients.
Mm-hmm.
And I think anybody who was not on this call today really missed out on your very thorough analysis and candid report on what you're seeing in the marketplace. And I want to thank everybody for being here. I see a lot of familiar names. I wish your faces were here so we could all look at you directly. You know who you are because I'm looking at a bunch of names. But does anybody have any questions for Richard at this point in time? Dealing with commercial, retail, apartment, or even out of market, because as we can see, there is life in real estate outside of Los Angeles, although, for everybody on this call, LA is pretty much our home base.
Yeah.
Any questions, you guys? Raise your hand or just talk. We could unmute you if you'd like.
Richard. Kevin.
Thanks, Richard, for just a wonderful little interlude of mixed information on a lot of things that I appreciate the insight on. My friend from the next door over is thinking of relocating the family down in Fort Myers, Florida. Her son and daughter-in-law live down there. And she was just getting ready to put her house here on the market. And now she's reconsidering because there's a whole lot more to look at. And I'm curious if after you went down there and did your due diligence for your own personal retirement plans or considerations, did you come to any conclusions about a permanent dwelling down there based on what you've seen and doing all the statistical work and still have the rug pulled out from under? Any thoughts?
That's a very good question. So I will say that when I first went down there, my two cities that were of interest were Cape Coral and Fort Myers. And I have a buddy who lives in Venice. Mm-hmm. That's been very hard hit. And he was kind enough to take me out to Sarasota to do some kayaking around the mangroves there. And we had lunch in little downtown touristy area of Sarasota. And I really fell in love with the place. Sure. I think it's just a fantastic little place. In the last week or so, I've been doing a little bit of research, trying to find out how badly hit those areas were. And it seems like most of the damage is within about a half a mile of the water, unless there's a river. If there's a river, then the river brought in more water.
Sure.
So I called a lot of places that were west of, closer to the water from where I would like to be in Sarasota, which is about 4 miles from the beach. And none of those places were flooded. And that was my most important question, because I felt that rising water would be the most damaging to any structure. The winds, just to give you a brief idea, a lot of newer homes in Florida are now built out of concrete block.
Oh, yeah.
We used to use that in Southern California, but concrete block doesn't work so good with the earthquakes. Wood frame house is a little bit more resilient, right? It can move a little bit during an earthquake if it's properly done. There's no flex in a concrete building, but boy, it's really good at stopping flying objects that are flying around at 150 miles an hour. So I'll share with you this little tidbit, and it's just a very anecdotal tidbit. I happen to know somebody who's building, I think, about 100 new homes right now in the Cape Coral, Fort Myers area. And they've got 100 new builds going on right now. Plus, they have an existing supply of 50 to 100 homes that were already delivered to investors, and they're renting them out, the tenants. By the way, not a bad play. Not a bad play, because you get a brand new house with concrete block walls and what they call impact windows, which are hurricane resistant windows. Don't have to have the pull down shutters and stuff like that.
Right.
You can buy a house brand new for $350,000 with those attributes built into them. And of the homes that they have tenants in right now, none of them were flooded. None of them had any significant damage. All of the damage was minor. Some people report no damage whatsoever. So we're talking roughly 150 homes altogether between what's being built, what's already been delivered, and what's in almost finished construction. No flooding, minor damage from things hitting the side of the wall and, you know, cracking a little bit of the exterior stucco that they rub over the concrete block. So where am I going with that? Yes, there's a tremendous amount of damage. Absolutely. No question about it. Many people are without power. Many people are just getting power back. My friend in Venice just got water and power back today. So it's been 10 days he's been without water or power. But his home, not so badly affected. And he's in Venice, which is a low-lying community, and it's a front community that faces directly out to the ocean. So I think that for me personally, I think that Florida still remains a very viable place to be. I would probably seek a little bit higher ground, which in Florida is hard to do because Florida is flatter than a pancake. It's flatter than a pancake. Look at a topo map. If you're lucky, you might find, you know, something with 20 feet above sea level.
That's been my experience.
Right, exactly.
Is your friend building those units inland away from the Caloosahatchee or from the Gulf?
Those homes are all in Cape Coral and Fort Myers.
Okay.
But they're removed from the water. I would say that they're probably about 15 feet above the water on average. And that's about all that they needed to keep out of that water. So the water didn't make it to the homes. And that's because they're all located probably about 2 miles or 3 miles from the water itself. We hear a lot about the storm surge and how high the water is. And of course, we've seen the devastation in Fort Myers Beach, which is kind of more of a coastal outlying community on the fronts directly to the ocean. They've been dramatically affected without a doubt. So you have the images that you see, but then if you look at closely, you'll find that if you're a little bit farther in, not so difficult. So I'm still very excited about Florida, but my friends that were all telling me you should buy oceanfront property because it's so cheap there. Maybe not. And I also like boats. And a bunch of friends have been asking me, why don't you buy a house on the canal? Well, for the exact same reason, because, you know, that water comes right along in that canal, flows in from the ocean, and it raises the water level. So I don't want my boats to be on my neighbor's front yard.
Thanks for the insight. I appreciate it.
Yeah.
Oh my God, thank you so much. And I'm only like agreeing with everything that you're saying because I do spend a lot of time in Florida. I go down to Miami at least once a year and I'm looking for property there myself. And I have my own stories, which I'm not going to get into. But before we close out, it's like past 6 o'clock. One final question for Richard. Anybody?
I do have a question for Richard. Why do you think, in your opinion, do retail property owners rather leave their spaces empty for years versus lowering their rates and leasing them out and activating the space? with the hopes of finding another tenant that, might be a higher end tenant that's willing to pay more down the road.
Mhm.
I live in downtown Los Angeles. I see so many spaces that have been vacant for years.
Yes.
And yet, I much rather have a little bit of money coming in a space that is activated and that will change the landscape of that area versus, an empty store that will, encourage tagging and just, the accumulation of homeless and God knows what else. So yeah, I would love to get your interpretation on that.
That's a good question. And typically what I see is, and I can only speak from the limited interaction I've had with some landlords about this issue. Oftentimes somebody who has multiple tenants within their property, they're a little bit nervous about Bob talking to Sandy.
Mhm.
And
Yeah,
Sandy says, I got a deal for $250 a foot, and Bob's in there for $375 a foot. The first phone call Bob's going to make when he gets back to his store is, I want to call my landlord. You got to bring my rent down. And the problem is that if you do that for all of your tenants, cash flow wise, you may be having a hard time carrying that property.
right.
That's the number one reason that I found during unstable economic times, landlords are sometimes just wanting to wait until things improve before they lease that space, because they don't want the rest of the tenants, and it makes sense, right? The tenant wants to be able to reduce their rent if it's possible at all. At the same time, the landlord's got the mortgage payment and the taxes and all of that other stuff that never goes down, right?
Very
So you have to kind of watch your cash flow, and that's one of the reasons I've heard in the past.
Yeah, and that's exactly the reason my clients, that I deal with commercial properties as well, and that is very much the exact response I get. But still, having a space that's empty for years versus, even lowering rents across the board, I mean, it
Mhm.
still seems that it would be a better financial decision to rent it out. But again, you never know. But
It's tough.
I'd like to share a hypothesis on that, because I myself were doing a lot of like smaller commercial buildings lately. And I wonder why buildings are vacant, or why certain things are happening. And what I'm thinking is, at a corporate level, or, whether it's an organization, LLC, or whatever it is, potentially these landlords want to have a loss. They want to have a write-off.
yeah.
They need to show loss of income, or, like from a tax perspective. And I just look at that and go, oh,
There is that. There is that element.
need to show a loss. I can give you examples, but I won't. And I just look at that as like, yeah.
Mhm.
That's true. So, Richard, if you're looking at it, putting an appraisal together on a space, a commercial space that has been vacant for years, how do you say, okay, the value is based on a potential income of X, Y, and Z, but is that potential income realistic based on the fact that it's been vacant and nobody wants it, or for 5 years, 6 years, who knows?
When it's been vacant for 5 or 6 years, boy, that's a big question mark. But
Yeah.
really, the role that the appraiser fills is to establish what market rent is for that space, and also kind of try to figure out what would be an appropriate market rent for that space, and get it leased within a fairly short period of time. During tight times, you put a sign up. Let me rephrase that. During good times, where the market is very tight, you put a sign up, and within a week you can have somebody walk in and give you the deposit, sign a lease, and they're fine. But I've been in some markets where sometimes it takes 6 months to find the right tenant. And part of our analysis includes what kind of concessions
Yeah.
we need to provide. And in a tight market, there's nothing. You want it, rent starts in 60 days.
Exactly. No.
Make
Absolutely.
sure your check is in the mail. But then in a tough market, you're talking TIs, you're talking free rent. And one of the biggest difficulties for a lot of landlords during this COVID period has been the fact that a lot of city offices are closed. So you go in, the tenant wants to get their permits done, and they need to put in this, they need to put in that, the inspector comes along, and it just turns into the most drawn out process ever. And it's just death by 1,000 cuts when it's a really bad economy, because you've got problems with cities, and you've got problems with tenants being able to afford stuff, and everybody's nervous about, because they're sticking their neck out, right?
Mhm.
They're putting their neck out trying to open a business during a rough period of time. They need all the help they can get. But sometimes you get a good tenant, and at some point the rent goes up, and you stabilize the property, and you're cash flowing. Yeah. But to answer your question, we try to find actual done deals. And I'm not talking about the current market, but I've been in some really bad markets where I've gone in and said, market rent is, 40% less than what everybody else is paying right now, because that's how the market is. And I've got data to show it. I've got active listings that are at that point. I've got done deals that are at that point. It's not a happy news for anybody who owns the property, or even the bank sometimes, because they're worried about the cash flow on the property. But over time, as the vacancy gets filled, as the tenant base stabilizes, as the tenants overall figure out how to deal with the new economy, then the property works out pretty well. But not good to have it vacant for 5 years.
Yeah, and that's what we're seeing in downtown Los Angeles. I'll tell you, there are a lot of spaces that have been vacant. 5+ years, if not longer. I know a few places that have been vacant for 15 years. Exactly.
I really wish I had that kind of money.
Yeah, I mean,
that I could let a $7,000 a month store just stay vacant for 15 years. That's, what is that, $1.5 million that they just gave up.
Yeah, so to me, it's mind-boggling. But as Candace mentioned, there are tax implications involved that may be worth the offset for said landlord. So
absolutely.
But we could talk about this forever. I have a lot of more questions that I'd pick your brain on, but we are butting up against at 6:10 p.m. right now. So thank you so much for all the information that you've shared with us this evening. And
my pleasure.
Anybody else with any questions?
If you want to reach out to Richard, just hit up David or myself. And if you need a commercial appraiser,
Yes.
He's your guy. He's your guy. I mean, I'm really pleased at the caliber and level of all the speakers that we've had over the past 2-3 years. And always hit us up if you want a referral or someone's information. In this case, Richard Hammel, because he is among the best.
Very kind of you. Very kind of you.
No, it's true. No, it's true. I know you. Thank you for speaking with us today, Richard. It's been awesome.
My pleasure. Thank you for having me.
Well, everybody, thank you for joining us again. Another month of Live at 5. We've been doing this since April of 2020. We really appreciate all your support. And we'll see you guys next month.
Oh yeah, next month we have attorney Joe Engel, who is a really fantastic attorney who deals a lot with probate. So how to protect your assets, how to put your properties in a trust. Everybody here, if you own property, it should be in a trust. And this is potentially very favorable and great information for your clients. So join us next month, please. First Thursday of every month, live at 5.
All right, guys. Enjoy your evening.